We're live. Good morning and welcome to Money Matters. My name is Nev and I am beyond excited to be here. We are doing this broadcasting live straight out of Providence, Rhode Island, only on one deal away. And today, do I have a very, very important episode for you? We're going to be covering stuff. I made you a promise yesterday that we're going to go into some charting and macroeconomic components to help you actually decide of what's going on in markets, what you can expect. But since then, a lot has happened as things are these days. And we're going to be covering a whole bunch of things of like what's going on with the GDP in the United States. What are the prediction? What can we expect for the second quarter? As you know, we're living in the second quarter, so we don't have final data whatsoever. But there's some forecasts and predictions from reliable sources that I think will blow up your mind and will confirm what I have been saying for a very long time. We're also seeing that the markets have completely decoupled from what has been going on and what's transpiring, and we're going to be covering that as well. I think you will be shocked, but not, well, maybe not. I was going to say shocked, but not surprised, but maybe you won't be, because I think everybody is realizing that the markets are fake. It's official, and I am saying it and claiming it here. Things have decoupled. The markets haven't been following what's going on in the economy with well over 40 million people that are unemployed. I'm going to say it's probably closer to 42 million because not everybody's reported. And the stock market keeps going up. We're going to be covering briefly seeing some of the biggest indexes in the United States, as well as covering what's going on with gold, with Bitcoin, and a host of other things. So I hope you're excited about it, and let's do this. And good morning. Welcome to Money Matters. So here we go. We're starting with the first news, and I apologize about this little guy. I don't know. I can't kill it. I keep kicking on the X thing, but it's not happening. And so we're going to go on and cover some of the things. I wanted to use this particular article out of U.S. News as a big picture of what's been going on and what you can expect, right? So, to sort of summarize what we're going to cover, of course, we're going to go into depth, and I think you will be hopefully educated and inspired to start paying attention and taking action for yourself, to protect your money, to protect your wealth, and really to do well in the not just upcoming, but we are experiencing right now the deflation, and I have called it a depression, and I honestly believe that we have entered this stuff. I do believe the civil unrest will continue, and we've been expecting this to happen. Just didn't know exactly how it's going to go through. And now you have people that are angry, but you have people that are angry for all kinds of reasons, and you have looting and theft and destruction of businesses, of private property, city, state property, and it's definitely interesting times. It's very scary times, and that's just kind of where we are right now. So stock futures hit 3-month high on prospects of economic recovery. What economic recovery, right? So, and I will explain exactly what I mean. There is no economic recovery coming anytime soon, y'all. I've been saying this is going to be, we're going to get a bounce and it's going to go straight down. So that's my personal expectation. Of course, not a financial advice. Nothing I say here is a financial advice. It's really meant to educate and, of course, share my personal opinion. So let's take a look of what they're saying. Some of the worst hit stocks in the travel sector, including American Airlines Group, United Airlines, Norwegian Cruise Line, and Carnival, climbed between 3.1 and 5% on pre-market trading. We're actually going to cover this stuff, and I will share with you how is this possible. They're not making any money. They're not earning anything. Nobody's traveling. Nobody's planning to travel, use these things as much. And they've had a hard time keeping profitability well before this hot mess. And I will share with you exactly how and why this is happening. So make sure you stay tuned. Economic data pointing to quick recovery, trillions of dollars in stimulus, and restart in businesses have helped S&P 500 climb about 38% from its March lows. Um, there's no economic data pointing to the quick recovery. I'm sorry, yes. News, yes, there's trillions of dollars that have been printed. And yeah, there's sort of the reopening, but I don't know that it's restarting because if you're a business owner, first you potentially have struggled earlier in the year, maybe not, maybe you were doing incredibly well, but then COVID-19 came, and then you had to shut down, likely losing a whole lot of money. And now, as you're about to reopen, your store potentially was destroyed, your inventory is stolen, and you are basically worse off than you were during the coronavirus or straight afterwards. So I don't know where they're getting their information because that is not what I am seeing. But this is one of those things that we do these things here because we all have an opinion, we all have a viewpoint. I'm sure you have yours, and I'm excited to hear what you have to say. Demonstrators set fire to Strip Mall in Los Angeles, looted stores in New York City, and at least 5 U.S. police officers were hit by gunfire. Hours after President Donald Trump vowed to deploy U.S. military. Um, Again, this goes right back to what restart and what quick recovery. We are entering some of the largest problems that we have experienced probably. I would actually, I know people are talking about the depression is going to be worse than the Great Depression. It's going to be the greatest depression. It's very possible, but I think we're entering a civil unrest, unlike we've seen since basically the Civil War in this country. And so that's just kind of where I stand. I don't know. I could be wrong. I didn't put the news report over here, but you can look for it yourself. The U.S. gun sales have jumped through the roof. And people are doing that because of the fear, and they're trying to protect themselves. But then potentially you also have people that are on the looting end of things and the protesting end of things. And, right now it's just, everybody against everybody, and it's a very sad thing to see, mostly because I don't think I think people are unhappy, and rightfully so. We have had this great divide where the rich get richer, the poor get poorer, and the middle class basically vanishes. And if you're lucky, you potentially join the rich, but vast majority of the middle class are not so lucky, and I'll explain why in the upcoming charts as we go through the episode. That they end up actually joining the poor. And so this is the reason when this happens, you start seeing this mass riots, mass rising, and we are experiencing that right now here in the United States very prominently. But I assure you, this is not, United States is not the only place that this is happening. The killing of George Floyd is what sparked the fire, so to speak, but it was always there. It was always there. And so that's not the only thing that is sort of moving things forward. So right now, I actually want to go in and let's take a look at the markets, and then we're going to go jump into what Fed is saying and cover these macro economic components, and again explaining some of the things of what's happening in the market. So here we go. Dow Jones Industrial Average is up. This is the 5-day kind of thing. You saw that on Thursday last week. It was a little bit higher, kind of tapered off. If we actually zoom out to 6 months, you can see that it's sort of kind of in the upperish channel, but it is definitely tapering off, and it's really bizarro that it's going up because of everything that's happening. S&P 500, pretty much the same story. Thursday was really good. You have Monday, which sort of went okay. If we zoom out to 6 months, pretty much more or less the same story, right? Then we go into the NASDAQ. NASDAQ was better yesterday with everything imploding than ever before. And NASDAQ is actually beaten. Have they beaten? Yes, they have. They have officially beaten their highs by a few cents, but they have officially beaten their highs. And so if you take a look at the Nasdaq, they are above. Yeah, they're definitely above the February high. This is absolute insanity. It makes zero sense, but this is where we are. Okay, let's take a look at Bitcoin. Bitcoin has actually broken the 10,000. It's finally officially happened. Bitcoin has been trying to beat the 10,000 level for the last, couple of months, I want to say. They have been trying to kind of hit that over 10,000. We were in February, then it kind of cracked, and then it kept coming pretty close, and it didn't happen. And this is a key level that is going on right now in Bitcoin. And I wish I could give you one day, but it's Yahoo Finance is doing something really funny. You can't really see it. I don't know why I chose it. I chose it because most people, I think, if they're not in the crypto community, they use potentially Yahoo Finance to take a look at the stuff. So that's why I'm using it. But there are different charts. I highly encourage you to take a look into that stuff. It is a key mark. Typically, when you have the round numbers, we've already covered this, like 9,500, 10,000, 1,000, 20,000. Those are key markers, especially if it was previously a ceiling that a particular asset was trying to break over, or a floor that it was trying to break under. And a lot of times you might see it bounce, but if it breaks, that's a very bullish sign, and bullish basically meaning expectations are that it's going to go up. All right, let's take a look at what's going on with the gold. So gold is doing pretty okay, kind of going sideways. Let's zoom out to the 6 months. And yeah, you will see it was sort of going in the up channel, and it's been trading sideways. There are some reports that are coming out that I figure I should probably share with you. Let's go to the 5 years and, and max. So you can see that it's been going up. We've had the dip. Obviously, this is the March thing. Since then, it recovered really nicely, but right now is trading in a channel. And there have been some reports right now that are showcasing a very strong case for gold to go lower. I believe that based off of what I'm seeing and what I will be sharing here with you as well, again, not a financial advice, just kind of where I sit right now. I do think that in a relatively speaking short-term period, gold will go down. It will go lower. However, long-term, it's going to perform really, really well. So there is a good probability that the gold is actually going to drop below 1,000. Again, we're not going to cover that today. I'm definitely going to be doing some geeking out and potentially sharing that stuff with you when we get through it. So, but I just wanted to share this with you. Okay, now I promised to share with you what's going on with the GDP, and Atlanta Fed has released a brand new estimate for the the second quarter of 2020. So that's what we're living in right now. This is very much not a real thing, right? It's a forecast. It's an estimate. It's what they think is going to happen. I've noticed that the New York Fed had done the very similar thing. I haven't checked St. Louis Fed, but you're welcome to do it as well. But Atlanta Fed has basically shared this information, I want to say yesterday. So yeah, as you can see, it was yesterday's information. And here is basically the chart. This was shared on Twitter. In case you are on Twitter, I am not yet. Maybe I will join. I am actually... I'll be honest with you. I gotta share something with you, to be completely transparent and honest with you. Is that I have for a while kind of struggled to understand what Twitter is and how it works. I tried it a few years back, and I struggle with the whole 160 characters or less because I am very long-winded, as I'm sure you know. Some people love it, some people hate it, but that's kind of where we are. And so I had a hard time with it, and I basically dropped it. But I am learning very quickly that these days it's probably one of the best places where you can get solid information, fast news, and that kind of stuff. So I might jump back in, but we'll see. Anyways, this is what was shared, and as you can see, they're sort of showing the blue chip consensus over here. Here is the green line that you see is Atlanta Fed GDP Now. I believe that they have an app called GDP Now, and it might be changing to Economic Now or something like that. So there's changing, but anyways, it exists out there. You can definitely look for it of what's going on. So here is sort of the range of the top and bottom 10 average forecasts of sort of what people are projecting. As you can see, everybody is projecting that at the beginning in March, they were like, yeah, it's going to be between like -5 and -25. Then it kind of moved to sort of in April, we were sort of sitting between -15 and -35. And, so this is kind of where we sit. None of these are good. However, they are projecting that it's going to be, let me see if I can zoom in because it's important for you to see this stuff. So here is kind of what they have done. So in April, they kind of put in negative 12% to GDP. I hope you guys can see this. Hold on, let me adjust this just a little bit. All right. So you should be able to see it now pretty well. So, in April, they kind of were down negative 12. And then, as you can see, it kept growing or going lower, depending how you look at it. And we went to negative 17, negative 35. It kind of set there, negative 40s. It sort of set there. Negative 40 again at the end of May. On May 29th, they basically said, nope, we are going negative 51.2. And just yesterday, they released the data that basically says, I hope y'all can see this, negative 52.8. Negative 52.8. That's GDP is basically the income for United States. It sort of projects the growth of what's going on, and we're shrinking our economy by almost 53% is what they're predicting. And so they could be right, they could be wrong. We won't know this because we still have at least 1 month. Well, we definitely have this month to go in it, and then it's going to take a little bit of time to sort of compile the data and push it out. So we won't know exactly what transpired in the second quarter of 2020 until July. And with 4th of July around the corner, when we hit July, it's going to be post that day. That's what I'm expecting. I could be wrong. Again, it could be a little bit sooner, but I'm expecting after 4th of July to receive actual information of what's going on. Now, what does this actually mean, right? So I told you that we were talking about gold, and I mentioned that I expect gold to kind of go down. And what does negative 53% mean when it comes to GDP? Basically means that the economy is going to shrink by 53%. And it makes sense, right? So many people unemployed, businesses going out of business, right? Foreclosures starting to happen. The liquidity is sort of put there, but not everywhere. Not everybody has it. The trade is going down. The rioting is going up. The trade wars are going up. So there's all these different things that are happening that is making this deflationary period that much stronger. And again, we'll cover some of the additional pieces that really support this stuff. But this is definitely beyond depressionary level, which is why I said we are entering a depression. There's no question about it in my mind. Again, I could be very much wrong, but I am just convinced, looking at the data, looking at what the Fed is showing, looking at stuff that I'm going to be showing you today and probably in the upcoming days and weeks, I think you will come to the same agreement. And so why am I thinking that gold is going to go down? Well, gold tends to go up in the states of uncertainty for sure, but especially if there is a belief that inflation is what's coming. That is not what's coming. Shrinking of the economy is deflation. People saving money is deflationary. Economic forces sort of shifting down is deflationary. All of the stuff, people paying debt down, people not borrowing, businesses shutting down, businesses closing, all of that stuff is deflationary, and there's no qualms about it. I think every anybody who studied economics or every economist will tell you the exact same thing. So I think you will be, take a look at this stuff. It's if you look for it, and they kind of give. Hold on, let me zoom out. So they kind of give a bit more. Why is it not zooming out? Come on. Well, well, now it really zoomed it out. Okay, we went from you couldn't get out to you couldn't see. Um, so they give this. It's a basically a five part slide that gives information. And right here in this slide, go just a little bit. Right here in this slide, you can kind of track by date of sort of what they're talking about. It talks about the GDP, but they're also putting some additional measurements of as far as the the exports and equipment and all these different different measurement devices that might give you a bit more insight into why they are, thinking what they're thinking. Okay, so I know this was heartbreaking to see, but I think it's important. Where we are going to go now is I'm going to keep my promise from yesterday, and we are going to take a look at a couple different articles from Zero Hedge. One is by Adam Taggart of Peak Prosperity. It's posted on Zero Hedge, and it's called "It's Decision Time. The market has reached its maximum stupid price limit." I don't know. You'd be shocked how stupid could grow exponentially. But this is what they're basically sharing and showing. So here it is. They're basically taking a Russell 2000, which is a small caps index, and they're looking at it, and you can see down here that it's showcasing it from in the 90s, in the early 2000s, right? So it's a 5 year sort of broken down into so that it's easier for you to kind of see, and you can see that we've had some sort of spikes and peaks and stuff that has been happening, and it kind of capped at around 60 or so, and it typically came right around some sort of calamity or crash, and now it's the most expensive ever. So let's take a look to what they have to say. The Russell 2000 index at PE ratio of 70x, which is ridiculous, has never been so richly valued. These are smaller, weakly publicly traded companies, a material number of which will likely be going bankrupt later this year if they haven't already. And over 40 million US workers are laid or so. Well, it's a little bit more than that at this point. The second quarter of GDP now expected to be down over 50%, 53%, as we just saw. And a half of U.S. small business expected to close down permanently. Agreed. The Fed buying spree has been tapering off. People don't know this, but I think it's important. And you can see kind of how it's been actually going down. And again, I can't kill this thing. Don't ask. I tried. So you can see that it sort of has been slowing down. And that's an important piece to take a look. Now, here is what basically is they're predicting that things are not going to continue, and that they're going to the time is of the essence, and that things are going to crash and slow down. So they have created a video that you can definitely watch. It's on YouTube. Just look for Market Mayhem Update, or just Peak Prosperity, and I'm sure you'll be able to find it, where they're discussing kind of what's going on. You get some additional charts. I did get a chance to watch the video yesterday, so it's pretty interesting. There's some good information. So towards the end, of course, they go into the sales pitch of what you can do and how you can make money. But good. There's some good discussion at the beginning, for sure, for sure. Okay, so here is the stunning chart, and this is the sort of meets the second really important thing that we're going to cover today, that really focuses on the macro. So we got to see a little bit about Russell, and we got to see a little bit about what's going on with the GDP and kind of where we are. You already know what's going on with the riots. So, excuse me. So here is all of the chart to talk about the modern central banking, kind of what's going on. Again, this is from Zero Hedge, and Tyler Durden. He's a fabulous writer. I really enjoy his stuff, so I highly recommend you just read his things. Okay, so to push inflation higher and jumpstart lethargic economy, central banks have to push rates so low as to make savings punitive and force consumers to go out and spend their hard-earned savings. This is the belief of this modern monetary theory that if you create zero rates or negative rates, people will basically say, "Yep, we're gonna go spend it because I don't want to lose my money." So we had Bank of Japan was probably one of the first ones. ECB has been doing it. I want to say Switzerland. So like a bunch of central banks have been doing it. So they continue to extend their insane monetary policy, which now includes the purchase of 80% of all Japanese ETFs. Now, don't even get me started on purchasing of ETFs because Fed is starting to do it with the BlackRock. And again, I think it's conflict of interest. I think it's criminal. But BlackRock has been hired by the Fed to purchase the ETFs of junk bonds. You can look it up online. Don't take my word for it. Do your own research. And a bunch of that money is actually going into their own ETF. Wait, what? Yeah. Yeah. So that's happening. And again, I think it's criminal. But then again, that's just my thoughts and my opinion. You can have your own and you should have your own. Until the central banks hit the inflation target rate of 2%. So they're basically saying, we're going to print, 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 print. We're going to cut, 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 cut. We're going to buy, 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 buy. And that eventually is going to bring us into the 2% inflation target rate. And then we're going to sort of stop. But there's a problem. The BOJ would not only not hit this inflation target, but appeared to drift even lower, as did ECB, S&P, and any other central bank that had gone NERP, which is negative interest rates. So then it says not only had household savings rate not declined in countries with negative rates, they had in fact risen. And so they're showing different charts of what's going on, which makes sense if you think about it, right? Because when there's uncertainty, are you going to go out and spend or are you going to go out and save? So, I think that that's kind of what we're seeing. We're seeing people wanting to save. They're not eager to spend. Every penny counts these days. And so you're going to keep a keen eye of what's going on and, put money away. Why spend it when you don't know what tomorrow is going to bring or what's going to happen in a year? Are you going to have a job or are you not going to have a job? Are you going to have that business? Not going to have that business? Is money going to come your way or not going to come your way? And you know what? When all of that happens, you save, 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 right? So what logically follows from this is that inflation would also track rates lower, resulting in a crushing blow to economic orthodoxy, where the only weapon central bank had left to spark an economic inflationary recovery was to ease monetary condition. So they would ease, people save. The more they ease, more people save. And more people save, lower the inflation, and, lower we go. Interesting vicious cycle. There is one last tool they can and will use, and that is helicopters. When it comes to printing money, whether in digital reserve format or physical paper format, there's literally no limit to how much can and will be created to achieve what is the end game of the current monetary dead end: the total destruction of fiat as a store of wealth in order to preserve the global equity tranche while wiping away a few hundred trillion in debts. We can now confirm that our intuition from 2015 that negative rates are not only not inflationary but outright deflationary and encourage consumers to save even more. A chart from the latest Research Investment Committee report by B of A, Bank of America, titled Stagnation, Stagflation, or Elevation, is a very interesting one. We're going to see it in just a moment. While lower rates indeed stimulate spending and lead to lower savings, this effect peaks at around 4% and then goes negative. In fact, the lower yields and rates drop below 4%, not to mention to zero or below, the lower the propensity to spend and the higher the savings rate. And now you get to see the chart that basically showcases this component. And you can clearly see it here of what's going on, right? You can see that it's sort of, spending kind of goes up. And then you see this piece that just takes a sharp decline. So a very, very interesting piece, right? It confirms that so many have known but they were afraid to voice as it ran against the decade of a flawed economic theory. Hyper easy monetary policy is not inflationary but is deflationary. Yet another nail in a coffin, as Mike Maloney would say, nail in a coffin. It is, it really is, of showing that we are, is deflation, 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 deflation. So I know a lot of people are saying it's inflation and it's going to be hyperinflation, and it might be at some point in the future. That is not where we are in a short term. It's very deflationary. Very deflationary, and when we finish this article, I will share with you what does work in deflation. As low growth and inflation make low risk assets scarce, households are forced to resume consumption and increase savings in order to meet requirement goals. Forced savings further depress demand in a vicious cycle. We just talked about it. The lower and more negative rates, the lower the spending, the higher the saving, lower the inflation, which in turn forces central banks to cut rates even more. Right? Like, it's just sort of silly. It's just sort of silly. And it makes perfect sense. If you think about it, it makes perfect sense, right? But for some reason, the smartest people that are guiding this whole thing, all these degrees, all these fancy stuff, and none of them see it. None of them see it. So they either don't see it, or they don't care, or combination of is just crooked. It's just crooked, and they're using it so that they can help their own people and their own network and people closest to them. And I think Max Kaiser says, the crony capitalism. So I think all of those things could potentially be true. Forcing more savings, resulting in even more disinflation, causing even more intervention by central banks, and so on, and so on, and so on. So monetary easing is deflationary. Bottom line, simple, plain and simple. Now, once trapped by NERP, there is no way out, as central banks spark even more deflationary with their policies. The one place where all those trillions in liquidity can go and end is what was once known as the market, and is now, in the words of Bank of America, the fake market, that leading to even higher fake asset prices and even greater wealth and income inequality, which ultimately tears the fabric of society itself. We just talked about it, y'all. We just talked about it, that you get these things, they have to go somewhere, they go into this stuff, it pushes the price up, and it pushes it predominantly from folks that don't know what in the world they're doing. And I'm going to prove to you that it is people who don't know what they're doing that are buying into this rally, and I fear that they will be very negatively affected very shortly. So that's coming basically right after this article. So we're going to cover what works, and we're going to cover what dumb money is doing, in my opinion. And anyways, just look what's happening to America, right? Rioting, looting, pillaging, American fighting over Americans, and so on. So Thomas Jefferson, right, the father of United States, warned, this is, centuries ago now, I believe that banking institutions are more dangerous to our liberties than standing armies. If the American people ever allow private banks to control the issue of their currency, first by inflation, then by deflation, the banks and corporations that will grow up around them will deprive the people of all property until their children wake up homeless on the continent their fathers conquered. This sends me chills. I don't know how you feel about it, but it's just so true. And sure enough, looking at what's happening, Feds, we are always reminded, is the private institution and remains private. And you can see kind of what's going on, and you can see that the private banks and kind of where it all lies, right? And this is all coming out of Bank of England. Okay, now, if someone could only explain to all those millions of angry Americans that the source of virtually all society's ill is to be found in the building below, this is the Fed, y'all, just happens to house an unknown amount of freshly printed dollar bills, it would be a much needed start to reset the U.S. so desperately needs to avoid complete destruction. So there you go. There you go. This article just does it so well, and I don't know where you are, how you feel about things, but I think that this, really showcase of what I was saying, of what's going on, that all these different things are causing more problems than they're worth, and the medicine is worse than the illness itself. Now, what works in deflation. This is not my opinion. This has been proven. You can research it. You can read it. It's been proven through the economies. In deflationary environment, cash is the king, and U.S. dollar, whether you love it, you hate it, right now, is going to be probably one of the best performing assets ever. We don't know. I don't know what Bitcoin is going to do in a short term. I don't know how it's going to behave in a deflationary environment. It could go up, it could go down. It's simply unknown. I am very bullish on Bitcoin and quite a few different cryptocurrencies long term. But in a short term, we could see lower prices potentially, or it could be higher. I just don't know. A lot of it is market and market confidence of what is going to sort of drive things. So that's one thing. But cash, we definitely know, works really, really well. And so having some cash, saving up as much as you can, that actually works really, really well. Again, none of this is financial advice. This is just my thoughts and opinions. You need to do your own independent research and find out what actually works for you. Now, I've told you that the fake market, the lying market, the whatever market that doesn't make sense market, and I told you it was the dumb money that is investing in it. And now I am going to prove it to you. So let's switch over to Robintrack. So Robintrack basically takes all of these different popular things that are being traded on Robinhood, and Robinhood is basically an app that excuse me. Robinhood is an app that provides ability for you to buy and sell stocks on the market without paying a commission fee. However, they're known to kind of sell the data and sort of trade against you and that kind of stuff. But a lot of millennials are using it because it's an app. It's pretty easy. It's pretty simple. It's right there. So just something to know. And so what they're doing is they are listing the most popular stocks that you can see. You can see a lot of airlines here. You can see some tech stuff here. And so, Ford is sort of the top company. And so one of the things that I want to use is there's a lot of sort of beliefs that, Uber is a good thing. And so I will share with you some information and stuff about things. So as you can see, Uber price kind of went down. It's been trending up because people have been buying and holding. It's sort of tapering off, but people are very bullish on this piece. Why is beyond me because, but it's happening. So here is, what I want to share with you. This is coming out of Wall Street. This was published about 2 weeks ago or so, but it is very, very valid right now, and it applies to what we're about to talk about. So let's cover this up. And kudos to the Kaiser Report because they talked about this recently, which made me want to look into this stuff. And so, they covered this very much in depth. So, again, one of the shows that I enjoy watching, and I think that they do a really good job. Sometimes it gets a little bit nutso. It's too much for me. But, they do have a very good and often entertaining shows. So what do companies Wayfair, Zillow, Uber, Lyft, WeWork, Carvana, Tesla, Airbnb, Casper Sleep, Zoom, and many others have in common in addition to their current former status as unicorns with huge valuations? Remember, Uber is part of it, okay? And we're going to take Uber in for a ride. So you can definitely check out the Robinhood tracks. But let's go into this. They market into profitable market industries such as retailing, furniture, house flipping, real estate brokerage, taxi operation, and so on and so on. They accomplished an amazing feat. They managed very successfully to lose running ton of money, not just the first year or two while getting on their feet, but year after year after year after year, many cases for decades or longer. Many of these companies have been around for over a decade, have tens of thousands of employees, and they're still losing a ton of money each year, even when it was good times. So even before the crisis, publicly traded companies were a money-losing bunch. In January and February, top of the market, y'all, top of the market. At the end of the good times, nearly 40% of the listed U.S. companies had lost money in the prior 12 months. But people are buying. Last year, were money-losing companies, including Uber and Lyft. In 2018, 81% were money-losing companies. It matched the 81% money-losing companies record set in the year 2000, the peak of the dot-com bubble, and then it all collapsed. Y'all remember that. Everybody was buying anything that had .com in the name, and then people lost a lot. Let's start with Wayfair. Wayfair is an online furniture reseller, right? You've probably been there. I've definitely been there. I think I might have purchased something when I was, refurbishing a home. The thing that makes Wayfair unique is that its losses have nearly doubled every year. All right, hold on to your chairs, y'all. Here we go. They're losing on an exponential curve from 77 million in losses in 2015 to 194 million losses in 2016 to 245 million in 2017, 504 million in 2018, and nearly $1 billion of losses in 2019. And I agree with them when they're saying, I dread to see what 2020 will look like. I don't even want to know what it will look like. But now we're going to go and jump in the Uber. And you know what? Before we do that, let's take a look at the Wayfair. So, as you can see, they have been reporting loss. But here is how their stock has performed. This is in 2018. Then they jumped in February. Now, of course, this is 2019. Here is the 2020, right? They dropped down. But look, they have outperformed everything. But the earnings per share, negative 11.51. Yep. And people are buying it. I mean, you could see the volume right over here. That makes no sense to me, but yet here we are. Uber, the global taxi operation with some side hustles in e-scooter rentals, food delivery, and freight, has lost $18 billion over the past 5 years. That was during the good times. Now, I've already shared with you Uber is cutting a lot of different jobs and stuff. So let's take a look at their stock. Now, they are not as volatile as Wayfair that has the highest losses ever. But, we've seen it kind of trading up. And again, you can see the volume. It's all on the green, which means people are buying. Take a look at the earnings per share, negative 6.66. That doesn't make sense to me either. But people are buying because they don't know what they're buying. It sounds sexy to tell everybody, I own Uber. Owning Uber might have been sexy pre-IPO when they went out, sold it out, made a bunch of money. Those that were early investors sold a bunch of things, and they're sitting pretty in cash, while the rest of the public goes in, buys it, and loses. These companies lose money hand over fist during the best of times. They're designed that way, and executives are rewarded that way, and investors want it that way. The genius lies in bamboozling public and corporate investors into enthusiastically and unquestionably going along with this whole thing, throwing a good money after bad. So, I don't know how you feel about it. You might be depressed at the end of this stuff. Unfortunately, I don't have a whole lot of good news for you today, other than, take care of yourself, protect your wealth, protect your money. Take a look at this stuff, different channels, watch what people are saying, listen to what watch what people are doing and listen to what they're saying, and make sure that it matches. Because oftentimes people say one thing, but they're doing something very different. So you want to pay attention to what they're doing. The second piece you want to definitely pay attention to is who is telling you what, and what is the motive behind what they're saying, right? If I was owning a gold refinery, I would tell you gold is the best thing to buy right now. It's going to outperform everything in the good times, bad times, sideways times, and deflation, inflation. It doesn't really matter, right? And I think it's good to believe in what you're doing and what you're selling. And I believe in what I'm doing and what I'm selling. And I am selling education. I want people to become sovereign individuals that can think for themselves, that don't have to listen to somebody who's saying, you need to do this, you need to do that. That don't fall into the trap of buying and investing in things like Wayfair and Uber when they're not making money. to be able to go in and short things when it doesn't make sense, or go long when things don't make sense at all. So, what I want for you is to start thinking for yourself, listen to different things, engage this guy up here, okay? It can do much more than you think it can, and do well by yourself. Take care of yourself, stay safe. Until next time, stay forever money blessed. And do remember, you are only one deal away. Bye, y'all.